Hi, I'm James, and in this video, we're going to talk about something you may have noticed over the past few months, and that is economy go down, but stock market go up. What's that all about anyway? We'll discuss. So first, I'd like to say thanks to Kate, who may be watching this right now, who recommended that I make a video on this topic. She didn't directly recommend it, but she suggested the topic to me, so thank you, Kate. Now, what gives? Economy go down, stock market go up. How does that work? So there are a number of different ways that we can approach this. Now, I'm going to break it down into two parts. Number one is that economic data is backward looking. Now, economic data, a few examples of this is GDP and unemployment figures. Now, when we talk about gross domestic product, that is information or data that's already happened in the past. Same for unemployment. It's backward looking. Now, on the contrary, the stock market is a forward-looking prediction machine. And we can see this through the way in which companies are valued. So companies are valued generally with PE ratios of anywhere from, say, 10 to 15, all the way up to 50 in the case of a company like, some of the tech companies in America. Which means that the prices of stocks is based on future projected earnings. Now, this can lead us to a situation where we can have some bad news come out around economic data. Say, for example, Australia has 20% unemployment, and we can also see on the same day that that data was released that share prices can actually go up. Now, that's because of a concept called priced in. And what priced in means is it basically suggests that information or news is already factored into the current price of a share. So for example, the news comes out that employment is down to, unemployment's up to 20%. Yet the same day, the companies jump by 2% in price. It doesn't seem to make any logical sense. Well, the answer is, what if the market had already predicted that unemployment was going to be 21%? So 20% unemployment to an ordinary person like you or I, that might seem like terrible news. But to the market, which has already priced in 21% unemployment, that's actually good news. Now, the same thing can happen with individual stock earnings. Let's just say the share price of a company is $10 a share. Now, the news could come out that says, revenue has fallen by 50% for this particular company, and the share price could go up by 10% in a single day, up to $11. You might look at that and think, this doesn't make any sense. Well, if we take the view of the concept of pricing in news, then we can infer that the market had actually predicted that the revenue reduction was going to be worse than 50%. Maybe the market was pricing in that revenue was going to be decreased by 60%, so that when the news came out that it was only a 50% reduction, that actually was positive news for the market, aka investors, which is why the price rallied off the back of that bad news. Now, the third thing, and I only said I was going to do two, but we're going to do three anyway. The third thing is what we've seen in the US and in Australia at the moment, and also across the world. And that's what we call quantitative easing. Now, quantitative easing, I've made a video on this recently describing why I'm investing in gold, silver, and Bitcoin at the moment based on QE. And so I'll leave a link up here to that video. But essentially, quantitative easing is actually essentially inflating the price of stocks. We won't go too much into that, but basically, the United States Federal Reserve, which is the central bank in America, they are injecting cash into financial markets, which essentially is increasing the demand for stocks, for bonds, and other financial assets, so other investments, which is actually driving up the price of shares. And our share market in Australia is closely tied to the US share market. So when the US share market rallies very quickly in a day, ours tends to follow suit and do the same, the ASX. Okay, so that's it from me today, a nice short video. Now, in conclusion, basically what this comes down to is the concept of pricing in news, which basically allows us to understand it through the framework of economic data is backwards looking, whilst the stock market is forwards looking and predicting the future. Okay, so I hope you found this useful. If so, please give it a like and let me know what kind of content you'd like to see next. Thank you very much, and I'll speak to you soon.